Good afternoon and welcome to the last Vincents webinar for 2015. My name is Ross File and I'm one of the directors in Tax and Business Solutions division here at Vincents, specialising in property, building and construction. Today I'm going to talk about the QBCC licence monitoring requirements. At the end of the session I'll try and take some questions. However, if time doesn't permit, I will contact you by email directly, and we'll sort through any issues. So, the QBCC is the Queensland Building and Construction Commission. This is the entity responsible for licensing builders and contractors in Queensland. Queensland appears to have a tougher regime of licensing builders and contractors than in any other state of Australia. As a result, builders will often prepare a Queensland-specific entity to deal with the licensing rules. About 12 months ago, the QBCC changed a rule which was subcontractors and contractors and builders are no longer required to lodge annual reports. For many of our clients, that's where they stopped listening. Unfortunately, the extra bit that is often ignored these days is the fact that the new rule requirements require a lot of things that the contractor, builder or subcontractor is responsible for, that if they're not financially savvy, they won't necessarily understand. The new rules impose a requirement to monitor the financials, to regularly calculate the net tangible assets of a business, to calculate the maximum revenue, that's the total revenue that an entity is allowed to turn over as a result of its licence, calculate the current ratio, and provide a minimum financial requirements report when it's needed. The details of these new rules are contained in the QBCC website. It's a bit difficult to find it easily. You need to click on the website homepage, click on Forms, Fact Sheets and Publications, click on Publications, and then you'll find the PDF of the minimum financial requirements for licensing. To make that a little bit easier for you, we've also added that document to the handout section of the webinar dashboard. So, the new requirements require the contractor, builder or subcontractor to prepare quarterly internal management accounts, and they're defined in the document. These they also are required to meet the minimum financial requirements at all times. So that's not just at quarter end when the internal management accounts are prepared. If there are any variations in turnover and assets, they must be notified and approved by the QBCC, and we'll talk about that a little bit more shortly. So net tangible assets is not as the normal accounting definition would have net tangible assets. There are many excluded assets that you're not allowed to count as net tangible in the calculation of net tangible assets. These are often related party type assets, but still it doesn't mean that they're not of value. On the other side of the equation, in calculating net tangible assets, there are no excluded liabilities. So any related party or loans from related parties are included in the net tangible asset calculation. Another quirk of how things are calculated is that assets may be revalued, but if you revalue an asset, it is to be considered a non-current asset, regardless of when it is able to be realised. So the importance of calculating the net tangible assets is your level of net tangible assets determines the amount of turnover you can do. So the amount of turnover you can do, and that maximum revenue, and that is all turnover, not just building and construction turnover, that's revenue from all sources, is determined by your net tangible assets. As you can see from the table on your screen, if you had net tangible assets of 480,000, you would receive a maximum revenue of 12 million. If you had net tangible assets of 156,000, you would get maximum revenue of 3 million. Depending on the number that your net tangible assets comes out at, you will get a number of maximum revenue. Now on the QBCC website there is an actual calculator that deals with all that. So often we have a request that, you know, my business is going well, so I want to increase my maximum revenue. How do I do that? Well, one way is to provide a guarantor through a deed of covenant insurance, so that effectively that adds to the net tangible assets and increases your ability to have a higher maximum revenue. The effect of a covenant in insurance is that the guarantor will guarantee any shortfall between the net tangible asset amount and the amount that the net tangible assets have to be. So in effect it's an open-end guarantee, and as a result we don't recommend that our clients undertake that open-ended guarantee. The alternatives that we would normally look at are transferring debt to equity, so things like increasing a share capital. So if you had related party debt, you may look to have that contributed as share capital, so that would then reduce the debt and increase the equity. Another one is to remove owner's expenses from the profit and loss, even if they're otherwise deductible. Effectively that increases the profitability of the entity and as a result increases the net tangible assets. The third one is controlling dividend policy to make sure that the net tangible asset doesn't drop too much. That's an important one, because if you go back to the continuous monitoring requirement, often a privately owned company may have a Division 7A issue for tax and accounting purposes, which means that in order to avoid a deemed dividend occurring, a repayment of a loan has to occur. This is often done through use of the dividend policy to provide a dividend after the end of the financial year. That can reduce the net tangible assets of an entity and can cause issues with the QBCC licensing. The next requirement is that the current ratio requirements have to be met. Again, this is complicated due to definitional issues. For example, trade debtors are defined to not include half of the trade debtors that are over 180 days old, all of the trade debtors that are a year old, and any trade debtors that are contingent. So retentions would normally come into that category. So although you think that you have trade debtors of a certain amount, they may be eroded by this adjustment that is required for QBCC purposes, but may not be required for accounting purposes. The current liabilities of an entity include any loans that there isn't an unconditional right to defer the settlement for at least 12 months. So any loan that is at call, any facilities that are at call, if you had bank bills that were rolling at a period less than 12 months, they would become current liabilities, and that would affect your current ratio. So the current ratio after those adjustments is current assets over current liabilities, and that must be at a minimum of 1:1. If the current ratio isn't met, then your license requirements are breached. So if your license requirements are breached, that can have significant consequences. A licensee is required to notify the QBCC at the time of renewal if any of the financial requirements for licensing aren't met. The QBCC may then either suspend or cancel the license at that point. Our experience with QBCC is that they will give you a period of rectification, and if you can rectify the issue that's occurred, then the license is reinstated. Often a builder or subcontractor or contractor won't contact their accountant at the time of renewal to make sure that all the financial requirements for license are met. So that can be problematic because they're often not thinking about the various nuances that we've been talking about so far. So one of the rectification matters or ways of rectifying a license breach is to apply for an increase in maximum revenue. An increase in maximum revenue is required where the existing maximum revenue is exceeded by 10%. So at some point the building licensee would have received a letter from the QBCC saying based on your net tangible assets, your maximum revenue, or in the old terms, allowable turnover, is X dollars. Whenever that amount is exceeded by 10%, a new report is required. Also, if the net tangible assets that the maximum revenue is based on decreases by more than 30%, a new report is required as well. So the minimum financial requirement report must be prepared by a suitably qualified person, and again these are all contained in the minimum financial requirement document that's attached in the handout. The report these days must be signed off by the licensee. That didn't used to be a requirement, and also the report must be accompanied by the signed financial statements where the report has been based on. So it used to be a fairly simple annual process of dealing with this report. Now you have to have effectively final financial statements, albeit they may be management reports prepared up to the end of a quarter. Those financial statements have to be reviewed for all the adjustments to trade debtors, to allocating liabilities into current and non-current portions, and those financial statements have to be signed off by both the entity directors and also the accountant responsible, and then a report is done based on those signed financial statements. That is also signed off by the suitably qualified person and also the licensee. There's a new financial requirement that has come with the changes that happened about a year ago, and that is the licensee must pay all undisputed debts as and when they fall due within industry trading terms. You can read all about that in section 9 of the minimum financial requirements handout. There's some exceptions to that, and what makes a disputed and what makes an undisputed debt. However, on the basis of a licensee not paying their debt, the QBC can suspend or cancel the license. In practice, what we're finding is the licensee is generally required to pay, before the QBCC will act, they will have a licensee who is not paying a court-imposed liability. So a judgment debt or the similar that basically can't be disputed, and they don't pay it within the appropriate time frame. In that case, we are seeing the QBCC act. It's not, at this point anyway, it's not something where they're just looking for people that aren't paying their subbies within the 30-day requirement. So that was pretty quick. In summary, it is a licensee's obligation to monitor compliance with the minimum financial requirements for licensing. That obligation has been moved from the licensee's accountant to the licensee. The licensee's accountant is deemed responsible for validating the financials and making sure that assets are collectible when they sign off their report. It's our experience that many licensees aren't monitoring or complying with the new regulations. A lot of it is because they're unaware. You know, as I said at the start of the webinar, all the licensee heard was they're no longer required to lodge an annual report. What they failed to hear was that there was a tightening of the rules, and effectively growing businesses and financially challenged businesses both need to monitor their compliance with MFR and make sure that they apply to the Commission in the appropriate format when various maximum revenue or net tangible asset requirements are breached. So beware the big stick approach. We haven't seen it used too much, but that doesn't mean that that it won't be used in the near future. As you can see from the changes that have occurred, the ability of the QBCC to suspend or cancel licences has increased, and it remains to be seen how they'll use that power. That's a very quick summary. I'm happy to talk to people if they've got specific questions. We here at Vincents have a lot of builders, contractors and subcontractors, so we're often across various problems that arise through both expanding businesses and financially challenged businesses continuing to trade in a manner that satisfies their licensing requirements.